Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 104 on March 8th, 2020. I'm your host, Eric, and I am super excited to get to episode 104. The main reason why is this officially marks 2 years of the Weekly Option podcast. So let me start this episode off by saying thank you guys so much for listening to me. Thanks for joining me on this journey. I really appreciate the fact that you guys listen. I really love the emails you send. And I've got a listener appreciation gift coming your way. Working on it. I was hoping to announce it this week, but it's going to take a little more work. So thanks again for listening. Feel free to share it with your friends. And it's been wonderful. I mean, this has been a lovely journey. And I get emails from everyone from, regular retail investors all the way up to hedge fund managers and people who trade professionally. And man, I just really am encouraged by you guys. And actually, this show and fully kind of fleshing out my scope of trading has made my trading profits increase. This show has made me a better trader. So thank you guys for that as well. And I hope to show you some love back real soon. In this week's show, we're going to cover the trades from last week on Golar LNG, the S&P 500 ETF, and the iShares Trust China Large Cap ETF. And we discussed 3 new trades on Sibanye Stillwater Ltd, American Airlines, and Barrick Gold Corporation. Now, it's always great to hear from listeners, as I was just saying. If you have any questions about the trades presented here on the show, or even about your own positions, feel free to email me. You can reach me at eric@theweeklyoption.com. That's ERIC @theweeklyoption.com. And I've also created a short video series to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, this week brought on more news, of course, about the coronavirus spreading to countries around the globe, including a rapid expansion of cases here in the United States. The markets did manage, however, to avoid another week of rapid decline. The Dow Jones Industrial Average gained 455 points, finishing the week at 25,864 points. The S&P 500 index grew 18 points, closing on Friday at 2,972 points. And now we're going to dive into the topic of the week. And for this week's show, our topic is uncertainty. Specifically, uncertainty is the name of the game. So for most of my life, I've had a plan, a 2 to 3 year plan, a 5-year plan, a 10-year plan. And now when people tell me they're, 3 to 5 year plans, I really find it hard not to laugh. In fact, there was one truly awkward moment where someone told me their 3 to 5 year plan, and I literally laughed. I thought it was hilarious. I find these statements hilarious. And you might say, why? It's not that I've become bitter and cynical over these years, but it's just because I've realized how much of life is uncertain. Like, even when we think we're in control, typically it's an illusion. Like, there's so many things we just can't control. So I still have hopes and dreams, of course. I told you I have all of my plans, but the level of uncertainty, or my level of certainty, often ends with my next step. So that next step is what gives me more information to lessen the amount of certainty on my path, right? I still, if I can't handle the uncertainty, I might not be willing to take the next step, or, in this scenario, place the next trade. So you've got to be able to handle that uncertainty. In fact, there are many shows, if you listen, you guys have heard me say before that, I still believe in a trade, or I'm waiting for one more day's data. Why do I want to see price movement for one more day? It's because that's one more day of certainty as I try to make decisions about uncertainty, right? I remember the quote from Heraclitus, Heraclitus, I believe is who said it, the Greek philosopher. And he said, the only constant is change. I'm sure you guys have heard that before. Well, in trading, the only constant is uncertainty. So I say the only thing that's certain is uncertainty. There will always be someone in the market that knows something you don't, right? There's information asymmetry, meaning all players don't have the same information. The only answer is to get used to uncertainty and making decisions without perfect information. And as you focus on an industry, or let's say you focus on a particular company in your trading, you will learn more about it. It'll actually create an edge, and that knowledge, that history really, and experience that you'll have with the industry or with the particular company actually makes news. It makes price movement a little more certain. But of course, the one constant in trading is uncertainty. So get used to managing uncertainty, and you'll be able to make more trades. A lot of guys and gals, for that matter, struggle to place their first trades because they just want to make sure it's going to win. And the truth of the matter is, you can't know if it's going to win. Like, you'll see the talking heads on CNBC, and they speak with certainty like, hey, the market moved yesterday. Why did it move? Why did it move? It moved because of the coronavirus, right? Like, they say hindsight is 20/20, and I actually don't even believe that. Hindsight isn't always 20/20, because oftentimes we still are left, making guesses about the reason for an effect, and without actually knowing the cause. So I've learned to trade. I've learned to trade and manage risk, so that I can place trades in an uncertain environment, but I know a certain outcome. All of the trades that I present, except the covered call, of course, the two spread trades that we present have it has one of two certain outcomes, and so I just have to make sure that those outcomes fit within my level of risk before I place the trade, and then I go for it. So that's it for this week's topic of the week. Get comfortable with uncertainty. And the more comfortable you are with uncertainty, the better you'll be able to make trading decisions and move forward and progressing your learning. Like, if you don't place actual trades, you will never become a good trader. If you don't place real trades, you will never learn the markets. It's just not the same. Paper trading is, you can paper trade all day long and feel like a genius. You're like, oh, this always goes up when I say go up, and it goes down when I say go down. But then when you put your money behind it, you realize all of these other things, like, oh, we are irrational beings, and oh, there is an emotional aspect to making these trading decisions with real money. So, the more comfortable you can get with uncertainty, the better you'll be. So now let's dive into the review for last week's trade. So we're going to start off at the covered call. We looked at Golar LNG, symbol G as in golf, L as in Lima, N as in November, G as in golf. At the end of last week, stock traded for $12.81 per share. I looked at buying that stock and selling the March 15 call at 30 cents. Hoping for a maximum of 19.5% return in 3 weeks. Well, Golar LNG stock fell $2.25 this week, closing at $10.56 per share. This isn't overly surprising given the pressure most stocks are feeling in the overall market these days. So the option we sold can be repurchased or bought back for 15 cents, which means that we gained 15 cents on that option, but it also means that we lost on the stock. We lost net position lost $2.10 per share. Now, I would typically look to roll the strike lower to pick up more premium and offset some of the losses, but in this situation, the March 12 half call is only a 10-cent bid, and that's not enough money to make it worth rolling the strike lower. So in this scenario, I would either look to exit the position or consider buying a put option. Now, when you buy a put option, you're short a call option because we sold that call against the stock. You have what is known as a synthetic stock position. So this position, being long a put option and short a call option, will gain money as the stock goes lower and lose money as the stock goes higher. So it's like being short the stock. So that becomes the perfect hedge against the actual stock that you own. So you'll have a long stock position because you bought the shares and a synthetic short stock position with your options. So understanding synthetic positions really is fundamental for people who want to trade options professionally. It's a little bit too much to dive into on air, but if any of you want to learn more about synthetic positions, just go ahead and email me and I'll get you some more information. Our next trade from last week is the credit spread. We looked at the S&P 500 ETF, symbol SPY, S as in Sierra, P as in Papa, Y as in Yankee. At the time, the ETF was trading for $296.26 per share, and I looked at selling the March 309-310 call spread at 34 cents, hoping for, or actually creating a maximum possible loss of 66 cents per spread. So this week, the SPY ETF gained $1.14, closing at $297.46 per share. The out-of-the-money call spread we sold is still out of the money. However, it did appreciate in value with a slightly higher move up in the ETF. The spread is now priced 27 cents at 46 cents, meaning if we sold more of the spread, we would receive less money than we collected last week. And if we bought it back today, we would pay 46 cents, but that would lock in a loss of 12 cents on the spread. Well, most of that loss would simply be due to crossing the bid-ask spread. There isn't much of a reason for a roughly 30-cent spread to have a bid-ask spread of more than 25 cents, other than people saying, these markets are very volatile right now. So all in all, as long as this ETF closes for less than $309 in 2 weeks, we will keep the premium we collected when we sold the spread. So we have about 2 more weeks to hold off and see if we're going to cross that threshold. And of course, our break-even from last week is, our break-even price for the trade is $309.34 in the ETF, which means that as long as we finish for less than that price, this spread will be worth some money to us. So that's good. Our final trade from last week is the debit spread. We looked at the China large cap ETF, symbol F as in Foxtrot, X as in X-ray, I as in India. And last week when we looked at this trade, it was trading for $40.66 per share. And I looked at the March 40 and a half put spread, buying that for 30 cents, which can give us a maximum gain of 20 cents or a 66% return in 3 weeks. So first off, let me admit an error I had. Last week, I gave the right name of the ETF. I told you the China Large Cap ETF, but I gave the wrong symbol. I gave you EEM, and that was incorrect. It just ended up kind of copying over from some previous notes, and I didn't double check it before I made the podcast. So the actual symbol was FXI, Foxtrot X-ray India. If you checked the prices, you would have caught the error in the symbol. And a few of you did and emailed me, so thank you so much. I just knew that making another podcast in the middle of the week, many of you weren't going to catch it anyway. So hopefully you validated that before you looked at it or made any decisions. But the China Large Cap ETF fell 40 cents this week, closing at $40.26 per share. So the at-the-money put spread that we bought last week is now in the money. Even though the market fell lower, the spread itself has not fully appreciated. So if the stock price stays below $40.55 over the next couple weeks, we will earn our maximum profit of 20 cents on this spread, which is a 66% return. So that's it for the trades from last week. This will be the last week that we look at March 2020 expirations, since March expiration is only 2 weeks away. We're going to start off this week, of course, with our covered call. I'm looking at Sibanye Stillwater Ltd, symbol S as in Sierra, B as in Bravo, S as in Sierra, W as in Whiskey, SBSW. The stock ended the week at $9.39 per share. I'm looking at buying that stock and selling the March 10 call at 40 cents, hoping for a return of 10.76% in 2 weeks. So you enter this trade by buying the stock for $9.39 per share and selling the March 10 call at 40 cents. This trade makes the most money if stock prices finish above $10 per share. The break-even price on this trade is $8.99 per share. In real terms, the stock purchase would require $939, and you would collect $40 per spread for selling the option. Now, our second trade on the week for this week is a credit spread. Looking at American Airlines, the airlines have certainly been beat up lately. American Airlines, symbol A as in Alpha, A as in Alpha, L as in Lima. Stock ended the week at $15.97, and I'm actually looking at selling the March 16.5 call spread at 24 cents, which can yield a maximum possible loss of 26 cents per spread. Now, let me just start off by saying, with this spread, this is actually one of the riskier spreads, I think, because the stock has come off so much. The stock could pop back over the next 2 weeks, but the amount of premium in it just made it a little too enticing for me. So we'll see what happens. I'm definitely going to play it close. But when you can collect 24 cents for selling a spread that can only be worth 50 cents, that's almost 50%. It's just shy of 50% on the trade right there. It's 48% of the spread value you're receiving just to sell the spread. So I'm going to take a look, but I'd be very cautious with this one because of that. So you enter this trade by selling the March 16 call at $1.65 and concurrently buying the March 16 half call for $1.41. This is a credit spread because we are selling the spread. This trade makes the most money if stock prices end below $16 per share, and the break-even price on this trade is $16.24. So you would receive $24 per spread that you sell and have $26 at risk. And then our final trade on the week is our debit spread. I'm looking at Barrick Gold Corporation. This was one of the first companies I ever did trade back in the early 2000s. Barrick Gold, symbol GOLD, G as in golf, O as in Oscar, L as in Lima, D as in Delta. The stock ended the week at $21.23 per share, and I'm looking at buying the March 20.5-21 call spread for 35 cents, which can yield a maximum gain of 15 cents or roughly 43% return on your capital in 2 weeks. You enter this trade by buying the March 20.5 call for $1.49 and concurrently selling the March 21 call at $1.14. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices finish above $21 in 2 weeks. So the break-even price is $20.85 per share, and in real terms, you will pay $35 to enter this spread, and your maximum gain is $15 per spread. So that's it. Thanks again for following me along, whether you've been listening for 1 week or 2 weeks or all 104 weeks. You guys are awesome. I hope you're killing it in the markets right now with all this volatility. If you have any questions, any concerns, do email me. I love it when I hear from you guys. It's fantastic. And if there are any topics that you'd like to see me cover on the topic of the week, feel free to reach out to me as well. Thanks so much for listening, and be safe out there. Obviously, with all the news of the coronavirus, I'm washing my hands. In fact, you know what? I'm going to go wash my hands again right now, even though I haven't touched anything. I touched the air, so I'm going to go wash my hands. But be safe. Keep an eye on this market because there's a lot that can happen. Like I promise you, the moment it's announced that there is a vaccine for this virus, just wait and see what the market does. It's going to be, I'm sure there's going to be a boon to it. So keep an eye out on your stock positions and your option positions. And that's it. Happy trading.
Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer, there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.